look at Solvency II and Basel III, which are the two big platforms of regulation that will determine, we believe at Tristan, the capital formation exercise. So it will reduce the availability of equity capital, it will substantially reduce the availability of debt capital. And in that sense, those are major themes, and I guess where we would question those pieces of legislation is the speed with which they are being implemented. A little bit like fiscal austerity. Longer term, these are sensible regulatory frameworks. In the short term, it's a question of how fast they're implemented. In terms of other aspects of regulation, we would prefer a situation where once the capital markets regulation is in place, that it's up to us and the allocators of capital to funds like ours at Tristan for us to negotiate amongst ourselves what they want from us and what we can give them. To the extent that AIFMD is a much more prescriptive way of telling us how to manage our money and telling the allocators what they should want from us, I think that's a shame. I think I would prefer that the investors are allowed to demand from investment managers like ours. On the other side of that, to the extent that it creates a level playing field and it forces, let's, for want of a better phrase, say the less well-managed investment managers to come to the standard that we would hold ourselves to at Tristan, that's fine for us too, because we want a level playing field. And what we would love is, of course, the investors drive that level playing field, but I think the regulators feel that they need to do more to force that level playing field themselves. I mean, the way we look at the costs of regulation in Tristan, this is what we do anyway. There's no real incremental cost to us of what we do, because if you run your business properly, you should be doing all the things that are articulated in IAFMD or the FSA rules or whatever. To the extent that it forces less well-managed firms to increase their cost base to run their businesses professionally, yes, there's going to be considerable pressure on the cost line. If the investors are as aggressive as we would like them to be in weeding out those managers that are not capable of running the money professionally, their revenue line will collapse too, because they simply won't be able to raise the money, which is what we think is going to be the summer of reckoning for a lot of managers. So that combination of revenues under pressure because they can't raise capital, costs going up, it's highly likely there will be significant consolidation.